Hello and welcome back to Prep for Retirement Television. I'm 𝗃𝗏𝗿, your host. We have another great show for you today. Joining me, local financial advisor Patrick Moriarty to discuss three more very important aspects of retirement planning. With more than 30 years working for some of the largest financial firms in the industry, Patrick started his own financial firm that has a focus on helping viewers just like you prep for retirement. He's here today to share his ideas and strategies to help you live a long and happy retirement. Welcome back again.
Yeah, good to see you.
Good to see you. So you always say that retirement planning takes more than luck. And each week we focus on three key topics related to retirement planning, three leaves, like in the shamrock of your company's logo. So today we want to start with market risk and volatility. Correct. What does that mean and how does it affect us?
Well, right now, again, it's a very, very hot topic because we've seen a lot of market volatility since the start of COVID, since March of 2020. And so we've seen the market go down dramatically. We've seen it go up dramatically, go to all-time highs. We've seen it come back down. It's now rallying again. So we've seen some extreme volatility in the last couple of years. And it's very, very important that the viewers, that the clients really understand what market volatility is and what market risk is. And seeing as I'm a fiduciary, it's required of me by law that I know my client. I know them inside and out. And one of the things I really have to understand about them is, what is their risk tolerance? What are they willing to lose if the market goes down? And I have that conversation with everyone I meet. And oftentimes I'll say to them, okay, you have X amount of money in your portfolio. How much are you willing to lose if the market goes down? And often the answer I get is, well, nothing, zero. I don't want to lose a penny. But what about on the upside? How much are you expected, or do you think you'll earn on the upside if the market goes up? And they say, well, I want all the market returns. So that's ideally what clients want, right? They want no risk to their principal and all the upside. But unfortunately, that doesn't happen. So we have to really narrow down what their drawdown limit is, what their risk tolerance is, so that we can build the proper portfolio for them. And I think it's important that they understand, how losses can affect them in retirement.
People you work with want one thing when the reality may be something completely different.
Right.
And I also know you have some numbers, some clear numbers to show us the power of market risk.
So I do a lot of workshops in the area, and I have a PowerPoint presentation that I use, and I have some graphics in that. And one of my favorite is this next graphic we're going to show that really explains market risk and volatility. And what it shows us is if we have an investment, and I really don't care what that investment is. I don't care if it's stocks, bonds, oil, gold, Bitcoin, it doesn't matter. We start with $100,000 and we hold that investment for 1 year, and after 1 year, that investment is down 20%. Now, we don't panic, we don't sell it, we hold it for 1 more year, and if it recovers by 20%, are we back to even with that portfolio? And the answer to that, most people say, oh yeah, we're down 20, we're up 20, we're even. Well, that's not the case, we're not, because the investment goes from 100,000 to 80,000, and then a 20% gain on 80,000 is 16,000. We're only back to $96,000. So we need a 25% gain to get even in a downward, the following year when we have a down market. So very simply, the bigger the loss, the bigger the gain we need the following year to be whole. If we add to that equation, we add to that situation that we're taking money out as well, so let's say a 5% withdrawal, a 20% loss, heck, that next year we need like a 33% gain to be even. That's what we want to avoid, and we also want to understand the importance of risk and volatility while we're in retirement. While we're working, it doesn't matter, right? We're adding to the portfolio, right? But when we're retired and we need income, we're subtracting money, we're taking money out. And I like to tell retirees that in retirement, losses hurt more than gains help. And we have to watch out for too much risk and too much volatility.
So really the question is, how can you avoid touching that money, taking money out when the market is not in your favor, when things are going down as opposed to moving up?
You're right. That's the hard part, especially when all of your money is at risk, or you have your money spread out all over and you really don't know where to take it from. in volatile times. My clients, I like to have those options. I like to have choices of where they take money at certain times of, the market movements. So I like to create 3 buckets. It's a 3-bucket system, and it's real simple. The first bucket is their safe money. That's their liquid money. I like to call it their local bank money, right? They have 6 months, 9 months, maybe a year of living expenses in a bank account that they could get to the next day if they needed it. If they need some new tires for their car, they need a hot water heater, they need a new roof, they have money that they can get. Second bucket is their principal protected bucket. That's the bucket that will not lose money. The principal is protected. It won't drop in value. Maybe that maturity in that bucket is 3 to 7 years or so, but we know we're not going to lose money in that bucket. Third bucket, well, that's our risk bucket. That's our stock and bond market bucket. It will drop in value, guarantee. It always does. Markets go up, markets go down. But that's the bucket that's longer term, 7 to 10 years. That's the bucket we do not touch when it's down. When it's up, sure, we can trim some of those gains, add it to the other buckets, but it's the timing. It's having choices of where you draw money from when the markets are volatile and when they're down.
Right. And shoring up buckets 1 and 2, leaving bucket 3 to just grow
exactly
as it can.
So that's the first thing, having this 3-bucket system. It's very, very important. The second thing that retirees need to do is have enough income, have enough guaranteed income, so they're not having to draw down all the time. If Social Security covers your expenses, great. You don't need more income, but unfortunately that's not usually enough. If you have Social Security and a pension, and that covers like all of your expenses, great. You don't have the risk of drawing down. But if you have a gap between the income coming in and your expenses and your needs, we need to fill that gap with more guaranteed income. And there are strategies and ways to do it. Sometimes we use annuities to do that. Annuities are guaranteed income that you can't outlive. So those are the 2 strategies. Those are the 2 best ways to avoid taking money out in a bad market and giving you options of where to take money from.
I imagine you have all kinds of people in different levels of distress.
Right.
Maybe they're doing great, and they come to you with questions wondering what to do with what they have.
Exactly.
How do you help them?
Well, we have to sit down and start from the very beginning. It's a planning process, finding out, what are their income sources in retirement? What are their assets? What type of taxes are you anticipating? What type of inflation are you anticipating? What are your spending needs? So looking at the whole picture, that's how we determine how to create the 3 buckets and how to generate more guaranteed income that they can't outlive. So it's doing a full financial plan, really.
Okay. And if people have questions, your team, you are available to answer those questions. What should they do if they want to get those
if they want to start this process, they can give me a call. We have a local number that we have set up for the viewers. It's 410-599-3300. We set aside 10 appointments a week for the show. They can grab one of those appointments, set up a time to sit down and meet with me. No cost or obligation. Don't bring a checkbook. We're going to have a conversation to see if I can be of some help to you. If I can, I'll tell you. If I can't, I'll tell you as well. We also have a QR code. If you're good with technology, pause the show, take a picture of the QR code, takes you right to my calendar, grab one of the appointments. I'd be more than happy to sit down and help you plan your retirement.